So does that surprise you? Oh, right. Do we have to say that it's being recorded? I think we have to mention that. Yeah.
I just remember that we were going to be recording it because it will be available on YouTube, on our YouTube channel afterwards. So sorry to interrupt you.
Okay, you know what? I'm just going to toggle back just for a second to the disclaimer, because if someone were to watch this on YouTube, they should understand this is only for educational purposes. We're not recommending anything. Don't invest based on what we say. Don't sell anything based on what we say. You know, just keep that in mind. Okay. So the ideal portfolio, according to one of the most successful, most admired investors of all time, is 20% real estate. And a lot of people are surprised that some, you know, a really big person in the industry was making that bold statement. That was a really bold claim to rely so much on real estate, because investors tend to think in terms of stocks, even though the bond universe is larger in terms of dollars than the stock universe, but people tend to really get focused on stocks. And then they definitely have, you know, they've heard of bonds, and sure, maybe they have some, but now this is broadening it even more to like, you've got to make yourself consider real estate to be successful. But one, you know, let's keep in mind though, he also, when he was writing his books, this is his second book, Unconventional Success, where he talks in depth about the 20% real estate. He also talks about the downside, like the fees that can be involved and how there's a real range. So, you know, we can get into some of that, but he's like, you also can't chase returns. So when you hear about investing in real estate, don't hear about like hot markets and try to jump on those. By the time you hear about it, it's probably too late. Never sell in a panic, which is a problem that we have with real estate investments that are public, and I'm going to talk about that later. And just in general, if you really want to delve into this, his book Unconventional Success is really helpful to get into what's available in real estate investing and what are the pros and cons. Okay, so investing in real estate, it is so much more. This is a vast, vast universe. Real estate is so much more than the single family house, though we're going to talk about the single family house because that's where a lot of people start. You can invest specifically in, you know, if you think public storage is the way to go, or senior housing, or cell towers, you know, because everybody has a cell phone, or the Amazon, you know, Amazonization of the world, and everything's going to be in warehouses, and all businesses are going to be directly, you know, you order it online and someone pulls it from a warehouse. Data centers, there are all these things that are really part of this vast real estate universe. So we're going to take a deep breath. We're going to expand our minds, expand our understanding. We're going to really think about this vast universe. But how are we going to think about it and keep it all under 1 hour? That's really tricky because it's sprawling, and I could write a book about it. I'm not going to, but I could. So let's try to figure out what's the best use of our time in 1 hour. And first, I'm going to talk about access to cash, because it's no fun thinking about real estate if you can't afford to invest in it. And there is a surprising way that you can invest that you might not know about. We're definitely going to cover the single family home. And then we're going to jump into real estate investment trusts and what they are and how to access them and things like that. And then we're going to talk about other things that are, you know, there are public REITs, there are private REITs, and then there are private kind of deals you can access. And then finally, there are significant tax advantages that everybody should just be aware of, especially if you have real money to put to use. The tax advantages are substantial. So that's a good use of 1 hour. And let's start at the beginning. Access to cash. It is incredible to me. I was explaining this to Siobhan, who runs the library, runs this section of the library, that I did not know until researching this webinar that it is perfectly legal to change the custodian on your IRA. So like, you know, a lot of people, if you have an individual retirement account, you have it at Fidelity, or your account is at T. Rowe Price, or your account is at Schwab. You know, maybe you had a 401k and then you left that job and then you rolled over the money into an IRA. And it's, you know, it's sitting there and you have some cash and you have stocks, maybe you have bonds, but that's typical. But whatever amount you have in your IRA, it is perfectly legal for you to buy an investment property with that money. It is perfectly legal for you to buy, to participate in some kind of group investing. Like if there's, a sponsor who's purchased an entire apartment building and you believe in apartment buildings in Nashville, Tennessee are going to take off and you want to participate in that and kick in $20,000, you can do that with your IRA money. So we're going to talk about that. And then some people can't even believe this because it's such a shocking piece of news to realize that whatever money they're seeing. Pete made it. Okay, wonderful. Okay, I'm so excited because I was hoping we could get a contractor on for your questions later. So now we have a lawyer, we have a loan officer, we have a contractor. So this is great. When we hit the single family part, everyone can figure out what their questions are. Okay, so access to cash. It's true. Here are just some samples of some podcasts you can listen to where there are lawyers talking, CPAs talking. It's totally true that you can use funds in your IRA to purchase real estate or to kick in on deals, a certain amount, with other partners and things like that. And when you do this, it means that you have to change the custodian of your IRA so that you can do a self-directed IRA. So you're going to have a different custodian. It's not going to be the typical Fidelity or T. Rowe Price. All the other rules apply. Your contribution limits to that kind of an IRA, the withdrawal rules. You can't withdraw the money early and all those things, all the things that normally apply to the IRA. But then when you go to invest it, if you're trying to invest this money, there are rules. Like you have to. This is not for you to purchase a home for you to live in. So it has to be an investment, and it has to be an investment that you don't personally use at all. I mean, ironically, if you think something's like a good destination for vacation homes and you purchase a vacation home with your IRA funds, you're not allowed to spend one night there. It really has to be separate from your personal use. And you can't, like if you have your realtor's license, you can't be the real estate agent on the purchase. So it really separates kind of your personal use and you making any money off of it in that way or enjoying it in that way. But you can absolutely use IRA funds to participate in real estate deals. And then the purchaser is your IRA, not you personally. So if this sounds at all appealing to you, you want to get some expert advice and, your tax guy, or you could start out just listening to some of these podcasts. If you, in the search engine of the podcast, just do self-directed IRA, all of these experts are going to pop up and you can listen to them. But it really blew my mind that this late in the game, I didn't even know that was an option. Okay, we'll start with the single family home. Who doesn't love the single family home? And I want all of you guys to keep in mind that we have 3 experts ready to take your questions. So if you have a legal question, if you have a borrowing question, if you have a question, suitable to a contractor, we have great people online. Pete Prattley is a contractor I've personally used. Jamie Tyndall is the branch manager of Loan Depot, and Radley Bain is a great real estate lawyer. So keep, jot down your questions, be thinking about, we have these people here, be thinking about what you'd like to ask them. Okay, the single family home. Full disclosure, I love investing in real estate, and I personally have rehabbed a few houses. I don't know if it counts as much investing wise if you choose to move into and use as your primary residence, a home that really needs a lot of work. You're just trying to get a good deal. But I've done that. And then I've also, in this example, I purchased this house up in the New Haven area where houses are much, much, much less expensive. And it was in horrible shape. And that was the opportunity because people didn't even want to walk into this house. It looked fine on the outside, was a nightmare on the inside. But rehabbing a house, being able to navigate those flaws and rehabbing it is so satisfying and also very lucrative. I'm just going to check out this one question in the chat. You can stay for 2 weeks with an investment property. Okay, that's really interesting because the podcast I listened to said you couldn't even stay 1 day. So that's interesting. Okay, so I might stand corrected. I thought if you buy something through your IRA, you're not allowed to use it at all, but there might be a little tweak on that. So again, get expert advice. Okay, thank you. All right, so the single family home, flaws are your friend. You find something that needs work. I'm trying to move the slide. This was another house that this one I actually lived in for a while. And when we bought it, there was no landscaping. So it was an estate sale, and the guy who wanted to flip it had only just enough money to go into the house and update the interior of the house. He didn't have enough money for even one shrub. So the outside of the house not only was so bare, but the backyard, the picture that you're looking at is the backyard. Because it was an estate sale, the backyard had grown for like 40 years. It had just turned into a jungle. And we got an amazing deal on this house because the landscaping was so subpar. And it wasn't that big a deal to literally just clear the backyard. I mean, once we cleared the backyard, it was gorgeous and park-like, and then do some cosmetics on the front. And we got a tremendous deal when we went to sell the house. So single family home, it's very straightforward. Find something, kind of a diamond in the rough and go to fix it up. But if it's going to be your primary residence, that's different, because you can lock yourself into a really good loan deal. And I'm definitely going to turn this over to the pros now, because and maybe Jamie, you can start with kind of talk, because Jamie was surprising me. I didn't realize how dramatically different it is to borrow for investing versus borrowing for your house, and how the rates are really not favorable borrowing for investing. But Jamie, do you want to talk about that? Like give some people, if they are going to invest, what they can look forward to?
Sure. And I just wanted to throw in, when I was doing a little research on the IRA and the LLC, and again, I'm not a professional on that end, but if you are using your IRA and you set it up as an IRA LLC and you were to buy an investment, just please note that if you're then taking in, like, where you're renting the home out, so that money is going into somewhere, it has to go into a bank account owned by the IRA LLC. It cannot go into, like, you set up an account that's something, otherwise you will have tax issues later on. And if you just Google that, you can sort of see where people had pitfalls where they had IRA LLCs and were using property, but then found they had tax consequences that they didn't expect. So you really do need to have an attorney, or financial planner, really make sure that that whole process is set up, which is not my field, but thought I'd throw that in there.
Yeah,
yes.
It's really separate entity, is just totally
completely
a
separate entity. Has to be the IRA LLC as the entity owning any bank account, even though the IRA LLC isn't a bank account, but you might have, for some bizarre reason, had someone depositing money. Instead of them depositing into your IRA, they're depositing into a bank account in some way, but that bank account has to be owned by the IRA LLC. Anyway, yes. So if you're buying just a home yourself, you can put down, well, in some cases, you can put down 0%. You can put down as little as 3%, and it's sort of a free for all, and you get whatever, when you're hearing on the news, 6% rate or whatever. But when you're buying an investment property, there is considered risk layering in the mortgage industry. So it sort of makes sense that risk layering would go from a primary residence to a second home to an investment property, in terms of, if something goes wrong in your life, what are you going to default on first? You're not going to default on your primary residence. That's where you live. You're going to let your investment property go, then your second home, and try and maintain your primary. So that's why the expectation is that you put more money down into your investment property, and that the interest rate is higher. Right now, you're typically going to put down, the least amount down would be probably 10 or 15% for an investment property. If you were doing something with an LLC, you are going to start up probably at 30 or 40% down. Your rates, if you just had a conforming loan, you hear the names Fannie Mae and Freddie Mac. If you just had a conforming loan, and they do not accept LLCs, so you were just buying an investment property, a rate there, if you were putting down 20% for a single family home, you're going to have a 7.625 rate, let's say. and an APR that's similar, with probably 1.5 points. If you put 5% more down, 25% down, you're going to have the same rate, but no points. So again, if the standard going rate today, and these are all just examples, and I'm not quoting APR or all the terms, is let's say 6% for going rate, you're a percentage of 1.5% higher for an investment property. And if you start risk layering by adding in, I'm buying a 2-family, a 3-family, a 4-family, go back a condo, something else, your rate is going to keep on perhaps getting higher, or fees getting higher associated with that purchase. And your mortgage professional would be telling you how that works and offering thoughts on, do you want to do A or B? My personal belief, Jamie Tyndall's belief, is that you want to invest as little as possible, which goes contrary to the way many people think, in an investment home. Because again, if there is something that is a life change that necessitates you to have cash in your pocket, you do not need to have cash in an investment property, a home that you do not live in, that someone else is living in. I would prefer to say that someone had that money sitting in a CD or somewhere, even if they said, I have all this extra money. So you would want to balance with your financial professional, with Kristen type of you have extra money. Well, what extra money are you putting into that real estate, into maybe that 20% to balance your portfolio, versus having still available cash on hand for any change of life circumstances?
Because people might be overconfident and say they have a lot of cash, and they're like, wow, I don't even have to fuss with a mortgage. I could just buy this for cash. And you're saying they will regret that. That is really exposing themselves to tremendous risk.
I have been in this business for, I think this is now 25 years, might be going on 26. And I can guarantee you, it's like every client of mine that says, I'll not say every, I'll say 80 to 90% of my clients who say, I'm taking a 15-year fixed loan because I want to pay it off. They call me later and say, oh, I actually want a 30-year because I want the payment lower, because now I wanted to buy a house in Florida, an investment property in Florida. I wanted to buy, my kids are going to college. And wow, there are all these $200,000 or $100,000 in like the Hartford area or less investment properties. And if I buy a house there as an investment property, I could buy a couple of them and use them as an investment, and they're college towns. And that's a great source. Those are, easily rentable, especially in certain college areas. Like Texas is a very popular area. I know Texas and Virginia and some other states have, a lot of density with that. But then when if you in your own personal home had more equity or paying more out, you don't have the money to do something later. And you don't know what that unknown is. It's not necessarily something bad. It's not about someone getting sick. It's like, oh, I wanted to invest in some real estate, so you put less down, so you still have cushion, even though you're saying you have cushion.
And you can always pay off your loan faster. I mean, it's not like you have to keep the loan. I mean, so it just gives you more freedom. You have a lower payment.
I have a client right now who is completing a divorce. She would ultimately she will pay off her loan in 10 years. We are giving her a 30-year fixed. I have told her what it will cost to pay off her loan in 10 years, what that extra payment is versus a 10-year fixed loan, weighed the differences and all that, so that she still has full financial freedom should in 10 years something change in her life and her goals and objectives also change.
Yeah, that's great. So please be thinking about your questions, because also at the end, we can circle back and Jamie and Pete and Radley can answer your questions. But why don't we move on to Radley, because I had asked Radley to give us some insights into people kind of partnering up to do these things and forming LLCs. So maybe you don't want to go it alone. Maybe you want to convince all your siblings or your best friends or your college buddies let's all do this together. We've heard Nashville is hot. Let's 4 of us together buy something in Nashville and rehab it. So Radley, you want to talk a little bit about that? Oh, you're muted. We have to unmute you. Siobhan, oh, there we go.
I'm unmuted now.
Great.
Right. So yeah, there are a couple of ways you could go about doing doing this. If you do want to pull your money, to get back to the IRA scenario that you brought up in the beginning, the LLC just has to have an operating agreement, and in that operating agreement, you just have to, you pick a name. You have to list all the members, their names, their addresses, email, and their initial capital contribution. That'll be on a Schedule A. The percentage interest as well. It has to come to 100%. When we have 3, 4, 10 people, we have to have 100% contribution. Generally, what you want to do is have a property, the operating agreement state that there's one manager. You could have more than one manager, but the manager doesn't have to be a member. It's preferable if the manager has a little stake in the, little skin in the game, but they don't have to, and then they could just be an employee. But the operating agreements that I generally have the money pooled together, and then if a property is not bought within 60 days, everyone gets their money back. So that's what encourages people who can possibly be strangers, we're done something, or friends, but not necessarily like a married couple, to feel comfortable with the scenario, because the manager will be, the member can rely on the manager to say, okay, well, we couldn't pull the trigger, we couldn't find a property, everyone gets their investment back. If you do find a property, then you can ask in the operating agreement, you can have a setup where there is a second contribution, and you give each person the opportunity to put in more money. If they don't, then you get a substitute member, and then that initial member's contribution and percentage interest decreases. So their investment exposure decreases, but their opportunity to gain money decreases. So there's two scenarios. One is you're trying to rehab and flip it in a very quick period of time. Then you just have to state how the allocations will be upon the sale. And that's not too difficult. If it's something you're going to lease, then you have to have like yearly distributions set up. And everyone has to agree with what that will be. In the operating agreement, also, you have to state clearly the property. You have to do one operating agreement for each property. So if you were interested in buying like property in Virginia and Texas, I need the address, and you have to put it in the operating agreement. You're only allowed to do things for that one property. And it will state to purchase, refinance, sell, lease, etc., for any legal purpose, including those things, but for no other purpose. You can't open up a car wash unless it's in the actual purpose part of the agreement. And that's just a general framework. So you have the contribution, you have the members, the managers, contribution, the allocations, and the distributions. And you have like a drop dead date to purchase. And every year you could do your distributions if it's a lease. Other scenarios, which are probably not as, I don't know, the operating agreements would probably be less pages. If you do something, for example, if you buy like a legal non-existing house that has, say, 2 structures on that property, you wouldn't need to have such a complicated operating agreement. And having 2 structures, if you lived in one of them, you might qualify for that interest rate for a primary home. That's one way to try to reduce your interest rate. Jamie can talk about that more, but I have a situation where there's 2 structures on the property. Person's living on that block and lot, so it does qualify as a primary residence, which is a clever thing to do, but it's very hard to find those properties, but they are out there. I have other people who haven't gone that far. They've opened up an LLC, and rather than go to Texas, where it's hard, you have to find someone to manage a property, they've gone up in Poughkeepsie. So they have people who, kids are going to school in Marist. They're going to the Culinary Institute. They're going to Vassar. Very, very affordable to buy these houses up there. You have families who just want to get rid of their houses for like 50, 60, 80 grand. These can be rented to college students every year. And the mortgages are generally low out there. Even if the rate's high, it's low monthly
It's off a
payments.
low purchase price.
Yes, it's low purchase price. So you don't have to go, like the college towns are great, but there's also these like the local ones. And you could set up, you could pull your money, and you could also drive to the property. So you can semi-manage it. You save costs that way, you know. So there's
Yeah,
just some,
let's not forget about local college towns. I mean, you have Quinnipiac is only a car
oh,
ride
sure,
away.
sure.
All these places, and when you listen, I've listened to so many real estate podcasts now, and they really emphasize go where the colleges are, because that's just, those are vital communities, and there's a real need for housing.
Yeah.
And if the college is like Quinnipiac is located in Hamden, where the housing is very inexpensive, and
Right.
you know, and all around, so you could definitely get a deal. And Vassar and Poughkeepsie, that's a great idea.
The other idea, which is a lot of my clients do, is Bridgeport. You've got Sacred Heart University. You have other schools around there.
Bridgeport University is right there.
Right. And so there are a lot of homes that you can get, and the students, they're like always rented. And they will also pay. A lot of people wonder, well, what happens during the summer? They will also pay for the lease to keep it so they don't lose the house.
Right.
So you don't feel, yeah, you know that, Bradley, like, so they don't feel like they're going to lose it. And
Yeah.
And someone like sort of the Candlewood Lake area will even say, oh, well, then for the summer, yeah, it just depends where you are, but usually you can still get the year lease. And
Right.
also the summer students and all that too, or, you know, whatever.
Yeah, I would make it a year lease mandatory, you know, if I could.
So Radley, when people do these agreements, do they also in the agreement say their intention to exit? Because what if you get into it and one person wants to keep it a rental and not sell it for years, and the other person's like, I thought we were flipping this thing, I want to get my money out. Like, is everything sort of decided up front?
Actually, you are not allowed to withdraw your initial contribution.
Well, what if
So-
you're like, I thought we were going to flip it, so I thought I would just get my money back in like a year and a
Well,
half.
the purpose of the company is put into the operating agreement, that everyone should be aware of it before they sign it. There's
So
no
that would be
provision
spelled
for
out,
I
like,
didn't.
why are we doing this? Are we doing this to create a rental, or are we doing this to flip it?
Yeah, you have to, well, you're giving the manager the authority to make those decisions. So it's the manager can make a lot of decisions without even the members' input. Because in the purpose of the agreement, it specifically says the manager has the authority to blank. And and the authority would be, you know, I would assume that everyone would know, this is what we want to do. We want the authority to be, find a place for X amount of dollars, pursue a loan. But to get out of your initial contribution, I think you're probably going to have a special agreement written that says you find a substitute contributor,
Oh, right. Someone could
or
buy
the
lunch.
remaining contributors agree to
Right.
elevate their amount. Like that's buried in, it is buried in there. It could be tailored so people are more comfortable, but you just don't get to throw your hands up and say, I'm out. Other than the 60-day provision where it's like, well, we didn't find anything to invest in. But actually I could write one, you know, that's more like tailored for that scenario, where if there's a disagreement, but it has to be in there ahead of time to save yourself a lot of headache. But I'm sure you'd find people are very happy usually to say, okay, I'll cough up an additional contribution. I'll be a substitute member. And you just have to really trust the manager.
And also, I mean, a lot of real estate is not liquid, you know, so this whole idea, like you can trade stocks, you know, every weekday, you have to have a different mindset around real estate. But, you know, we don't have a ton of time, and I wanted to pull Pete in. And I don't know, Pete, what's the most important thing we should know? Like buyer beware, or what are the, you know, I'm sure you've seen it all. So do these things, you know, go smoothly, or do people get nasty surprises?
I've been involved in several, and some of them have made over 100% return in 18 months, and some of them have been screaming matches in attorneys' offices at the end. So there's been capital calls, and some people coming up with the fine term that I love to, I'm not throwing good money after bad. And I'm like, well, then you're going to lose all your money because we need 100 grand to finish this project. So, there's always going to be things that come up. There's going to be surprises from town hall and building departments. So you try to go in with someone that's very experienced in doing that. In my 32 years of doing this, there's still stuff that comes up. So you and I, Kristen, have done deals together, and you know that I have a pretty detailed spreadsheet. So I try to like nail it down as much as possible, but there's always something that comes up. So you just have to be aware. It's not just like, yeah, we're going to go buy real estate and make a ton of money.
Not for the faint of heart. Well, you guys, thank you so much. I hope you'll stay on the call in case people have questions at the end.
Sure.
But we only have our 1 hour, so we are going to move on to, if maybe that scared you off a little bit, you really don't actually have to do anything. There is a way to get involved in real estate, have your hand in real estate, just by writing a check. And that's, real estate investment trusts is a passive investment. And I'm going to talk a little bit about the public ones. Those are very easy to understand. And then about the private ones. But the way to really understand a REIT, a real estate investment trust, is, start with, think of a mutual fund, right? So this is one example. This is a Loomis Sales growth fund. So Loomis Sales is just the company that's running the fund, and growth meaning these are what they're putting into the fund, the stocks they're putting into the fund. There's kind of this theme of companies that are poised to grow, like a Netflix or a Monster Beverage, or things like that. So most mutual funds, when you really study them, they have this kind of theme. They're going to say it's a mid-cap value fund or a small cap fund, or so they're going to talk about like the size of the public companies that are going into the fund, and what of those companies are poised for growth, or whether those companies are just, tried and true, giving a nice dividend kind of value companies. So, a mutual fund is like all this money being pooled to purchase these different, equities in this case. And then, and anyone can participate as long as they have the minimum investment. So they can have the benefits of this kind of vast portfolio with a much smaller amount of cash, and then they're participating in that investment. And so a REIT can be very similar, is often very similar. It's just real estate focused. So here are 3 examples of REITs. These are all publicly traded, and so that's why I included their ticker symbols. But MAA focuses entirely on, they're called multifamily, but sometimes people get confused with what that means. But basically think apartment complexes in sort of mid-Atlantic and southern areas that are considered very up and coming and kind of reasonably priced. And that's what they do. They've purchased all of these rental apartments and put them into one portfolio. And if you believe in rental apartments and the fact that more people are renting now, fewer people are buying, and if an apartment is like, if they vet the people well, and they only let people rent who have the means to fulfill their lease, and you think, hey, that's good cash flow, that's good value, there's going to underlying appreciation of the actual rental property. If you think that's a good investment, then you can go into a REIT that focuses on that. Maybe you think public storage is a good investment. There's certainly been a proliferation of public storage, and there seems to be a real need. So you can go into a real estate investment trust that's focused entirely on public storage. You could go into a real estate investment trust that's focused entirely on cell towers. You can go into a real estate investment trust that's focused entirely on data centers. Data has become a really big deal since so many businesses are data driven. And then, this last one here, Simon Properties, they're just all about shopping malls and sort of like the mall shopping and dining experience. So, there are all different ways to get your hand into real estate. And very often REITs pay, good dividends. So there's like a nice consistent stream of income. And then they're hopefully, the REIT itself, the price of the REIT is going to go up and you make money that way. But this is I totally get it, and it makes sense to me, but this is my problem with public REITs, and especially in the last year in a down market. So I know this, sometimes charts are a little confusing. This might seem a little confusing, but I just want you to look at how all of the different colors in this chart are kind of behaving the same, because each color is a REIT except for the baby blue, which is the S&P 500. So what is the point of diversifying into real estate if at the end of the day, every REIT is behaving exactly like the S&P 500? You haven't achieved any kind of diversification. And this is the thing that really concerns me about investing in public REITs, because a public REIT acts like a stock, and people in a panic can pull their money out, and that will lower the price of the REIT. It doesn't mean that anything has actually happened to the investment portfolio the REIT represents. So if people decide to sell the public storage REIT, if everyone's in a panic and they're just sell, it doesn't mean that public storage is dumping their storage facilities. Nothing's actually happening to the underlying portfolio, but the REIT itself and how it's priced is getting affected by the behavior of people jumping in and out. And for this year, because this looks at the last year, these REITs are behaving almost exactly like the S&P 500. So you haven't achieved anything by going into, I mean, you get a nice 3.5% dividend, so it's not totally terrible, but you really haven't achieved the diversification that David Swensen, who was running the Yale Endowment, what he was talking about. That like a real diversification is your investments don't mimic each other. So that's my problem with public REITs. So, okay, what about private? If you're going to go, there are private REITs, and then there are just kind of private deals that you can be a part of. And for the exact same underlying assets, private deals of like, joining up with some outfit that's buying up rental properties, or joining up with some outfit that's buying senior housing, or joining up with some outfit that's buying mobile homes. I mean, all of these, there are these private companies, and they're looking for money, and they'll let you participate and share in, the fortunes of what they're collecting, and you just do it privately. So that it can be private specifically as a REIT, or private like you're just giving them money and you're part of a deal. And there's been a total explosion of companies online that are doing this, that are offering these private options. And fintech and, finance meets technology is this huge theme now. And anything that used to be done privately, maybe with just like, ultra wealthy manager, people managing money for the ultra wealthy, making deals with the private real estate companies or the private equity guys. A lot of that is now happening, for everybody. It's supposed to be sort of a democratization, if you will, of all of these things that only the wealthy were doing. And all of these companies online have just kind of come out of nowhere to become huge. I mean, billions of dollars are flowing into these companies. You might have seen Fundrise. They had huge ad campaigns like 2 years ago, and they have a very low initial investment, which is unusual. A lot of times people think that all of these private deals are only for accredited investors. And two things. One, some of them are for accredited investors, and a lot of people think they would never qualify to be an accredited investor. But by Greenwich standards, the bar is not set that high. I mean, if you're married and you, as part of a married couple, have earned $300,000 2 years in a row, you're done. You're good. You're an accredited investor, even if you know nothing about investing. I'm not sure that's smart, because people can earn incomes and have no idea how to invest. But it's that's a relatively low bar. Or if you have $1 million saved, and that's where you can tap your IRA again. Somebody's older, has $1 million saved, they can be an accredited investor no matter what they earn income-wise. But in any case, a lot of these things, these options that came online, people just assume, oh, well, I can't do that because that's only for accredited investors. And I'm not sure exactly how some of these outfits are getting away with offering things that are not for accredited investors, but they are. But Fundrise and Cadre and Realty Mogul are, you can look them up yourselves. They're very well known. And this is kind of where the industry seems to be going, just more and more with these big online options. And you sign up and you're really like never talking to a person, and you kind of put in all of your information, and you get to look at all the different offerings, and they'll show you some, cool like high-rise apartment in some area, and you can get right in and participate. And it's kind of mind-blowing how you might never meet any of these people, and you're just adding your money to the pot and hopefully getting a good return. Not liquid, a lot of these things, it's like you have to be in for the long haul, but the yearly returns are good. Cadre is kind of an interesting one, has very impressive backers. The guy who runs it, it's kind of a whiz kid out of Harvard, and so Harvard and he worked at Goldman Sachs, so Harvard and Goldman Sachs are on board, and he wants to take this company to a certain level. I mean, I definitely was impressed by like his thinking. I think right now you have to be an accredited investor, but within 18 months, he's trying to make it so that anyone with $100 can get in. But one of the things I really liked about him is in this age of like socially conscious investing and diversity, equity, inclusion, he's really trying. He's the only person I've heard who's really trying to hire, like minority real estate agents, minority sponsors. So sponsors are the ones who actually buy an actual apartment building and fix it up, and then they can sell it to Cadre and things like that. So he's really, really interesting. And he's found a way to also make this thing that's usually not liquid, somewhat liquid. So there's a lot of really interesting stuff going on there, well beyond public REITs. And I'm down on public REITs because public REITs just mimic the S&P 500, mimic the stock market right now. So I don't know what you're accomplishing other than just getting a nice dividend by going into REITs. So I do think private is really worth investigating. These online options are really interesting. You can go to any of these companies and kind of, look at their website and see what they're up to. But then if you decide, that's still not for me, what I really want is the personal touch. I was hoping that Thomas Black could be on this call, but I don't think his flight was delayed, and I don't think he was going to make it. But I was going to have him talk to you because in this universe, and I'm not specifically recommending Nepali Capital, I'm not recommending anything, but the more you find out about this universe, if you want to get in on private deals, you find out that like doctors talk to doctors, engineers talk to engineers, athletes talk to athletes. So there are all of these private opportunities where the person running the fund, is a cardiologist who decided, what, I want to help other doctors, make money. They work so hard. I'm going to create this fund that gets into all the real estate. Again, it's like everyone's doing the same thing. They're looking at multifamily, they're looking at storage facilities, they're looking at college housing, but maybe what you want is some affinity. Like you want to be part of something where people can relate to you. I mean, there's a group out there, a husband and wife team, where they always tell their investors, bring your kids, your kids and my kids, and we'll all go out and we'll show you the investment properties, and then we'll all go out for ice cream. I mean, it's amazing the stuff that goes on there, where they really feel like not only are they good business people finding really good opportunities, but they want you to feel like you're kind of part of the family. So again, you do your own research. The podcasts are a great place to start, but you start to see that people are really, there's almost like an affinity aspect of, I can relate to these people. They're making good business decisions, but they also understand me because this person's an engineer. He was an engineer before he got into the real estate business, or this was a doctor, or this was an athlete. And there's just a ton of that, and it's really cool. And and the cost of getting in, again, with your IRA, they're all accepting IRA money. So you might think you don't have money to invest, but it's kind of funny. Like you get almost a little investing family out of the deal, and everyone meets once a year for annual meetings and things like that. It's kind of, I don't know, I found it very appealing and certainly very interesting and worth your time to look into. And I'm so sorry that Tom couldn't be on the call because he's the one who was a doctor. I think he actually continues to practice one day a week as a doctor, and then otherwise is raising money, and mostly from doctors, and then doing real estate deals. Okay, significant tax advantages. I am not a tax expert, but the more you study real estate and the opportunities that exist in real estate just over and over and over again, the tax advantages are highlighted. And I hope I'm going to do this justice, but if you do invest in something, you fix up something, you buy something, or you buy a multifamily or something like that, and there's rental income, it's, you're getting all of this income from rents, and you would think, well, that's going to, trigger a lot of profit, and that's going to trigger tax. The depreciation laws around real estate are really unbelievable. So as you have this cash flow from rents, you're allowed to depreciate significantly. And then you kind of have to back out of the depreciation later if you ever sell, and that can trigger a big capital gain. But they've got a solution for that too. But it's really extraordinary that you can have all of this cash flow from rents and really not get slammed with taxes. So that's a tremendous appeal for people. If that's an appeal for you, if you're looking for cash flow, you definitely want to consult a tax specialist. And then they have these 1031 exchanges. So I guess a 1031 is part of the tax code, where if you do very well and you find something and it appreciates and appreciates and appreciates, and now you go to sell it and you have a big capital gain, there are rules where you can take that money, and as long as you roll it into a new investment that's of kind of like kind or a similar investment, you do not have to pay your capital gain. And I have no idea why this rule exists, or like, why is everyone being so nice to real estate moguls? I have no idea. But if this is the way you want to go, this is why a lot of people are in real estate. So you want to find out about these things. And then Chris Franco in town, who's does very well with Chris Franco has been doing things in town real estate wise for decades. He was telling me about opportunity zones to the point that I couldn't believe it. I mean, I knew there were opportunity zones. I knew there were ways, in Bridgeport or New Haven or bad neighborhoods, that they're giving tremendous tax advantages to people who participate in these opportunity zones. But I had no idea that along Innis Arden Golf Course, the houses that are technically part of Stanford, that's considered an opportunity zone. Give me a break. But it is. And Chris Franco's got deals going where he's raising money and letting people participate in rehabbing those houses. And again, it has all these tremendous tax advantages. It has everything to do with capital gains. So I think you kind of have to already be in this game, and something is going to trigger a capital gain, and then you're looking to not have to pay that capital gain. But if you are in that situation, you can go into an opportunity zone. Your capital gain will be lowered and then possibly eliminated after 10 years. It's fascinating. So all I can say is real estate and tax avoidance, legal tax avoidance, go hand in hand. Find out more, talk to your tax guy, and also sign up for the next webinar. So our next webinar is March 14th, and it's all about why do stocks move? Why do stocks move in the short term? And very often it's not the fundamentals, it's not the earnings, it's all these other things that people should know about, especially if it's going to trigger them to panic and sell, because something might go down and might come right back up again. So definitely sign up for that. And if you have any questions, try to ask them now. Otherwise, you can always email me, kjacks@moneyinyour20s.com, and I will try to get the answers for you. And, we still have our experts here, Jamie on loans, Radley on legal, Pete on construction. So if you have any questions, ask them. Otherwise, I'm going to just toggle back to their information so you can follow up with them directly. And that is that. So let's see. So we have 23 participants. I don't see anything in the chat, but feel free to add something, any questions, or write down these emails, write down these phone numbers, follow up with who you need to follow up with, and that is great. Let's see, what have we got? Oh, we've got one question. I think the 1031 restriction goes away after 18 years. Okay. See, I'm not a tax person, but this is why it's fascinating, these podcasts all about these 1031 exchanges. So if you are
Actually, I've read in that 1031 exchange
We lost you.
Is he frozen? Radley, you're frozen. Okay, oh, we've got a thanks. This was very informative. Well, you're welcome. And it's also being taped, so you can always listen to it again if something didn't quite make sense. I wonder if we're going to get Radley back. All right, I don't know. Radley? All right, well, you see Radley's number, so if anyone has a question for Radley, it's right there. And Siobhan, I think we're done.
Okay, thank you. Fantastic. This was
you.
great. Thank you, Kristen and Pete and Jamie and Radley for joining as well. And like Kristen said, this will be up on our YouTube channel if anybody wants to watch the recording again. But have a great night, everyone.
Thank you. This was really fun. Thanks so much. Thanks for joining us.